and welcome to the one-to-one online EMEA event. Today, I'm here with Ole Hansen, Head of Commodity Strategy at Saxo Bank. So, Ole, thanks for joining me here today.
Thank you very much for having me, Amy.
And today we're just going to kind of do a nice little overview in terms of your outlook for precious metals as well as kind of the other commodities. So, to start off with, let's look at gold. So gold has seen pretty elevated prices in 2023. The price is getting towards that $2,000 mark. What are some of the main pressures on the market, putting the gold up to this place? And where do you see pricing moving as we kind of head towards the end of the year?
Well, actually, as we have this conversation, we are once again just trying to are getting close to $1,900, having traded within the 1,900 to 2,000 ish range now for the past couple of months. Once again, just raising some negativity in the market about the gold's ability to move higher. Something that I disagree with, but the drivers that we are seeing in the gold market has seen this year, because I think it's worthwhile mentioning that we are still up around 5% on the year. This is still a year where we've seen a fresh spike in bond yields, which tends to be having a negative impact on gold. The dollar as well has been fluctuating, but generally on the weak side, which has been adding some support. But the focus is well and truly still very much transfixed on the U.S. economy and the FOMC, where they go with regarding interest rates. And we did see that spike back in March when we had the banking crisis. The market was rapidly priced in going from a rate hike cycle to a rate cutting cycle. That was quashed because economic data has continued to hold up. Inflation is slowly coming down, and that has reduced the need for gold as an alternative investment in your portfolio. At the same time, we had the whole AI hype, which has been underpinning parts of the stock market, again also reducing the need for alternatives. So this is really where we are at this point in time. And what we're looking for in the months and quarters ahead is basically the risk that we may start to see some what we call stagflation light, that the U.S. economy will be slowing. It will reduce the company's earnings abilities, thereby reducing the upside potential in the stock markets. We believe that inflation is much more sticky than the market is probably pricing in at this point. We have come down quite rapidly from the 40-year high we had last year, but getting back down to the 2.5% area, which is the expectation or the target for the central bank, is not something that we see will come to fruition. And when that happens, or when that realization starts to emerge in the market, we will see real yields come down, because right now real yields is a massive problem for central banks, and because of the very, very heavy debt they're carrying, and they probably need to see force real yields down at some point. And obviously higher than expected inflation would support that movement. So we see a peak in rates. Maybe we've seen it already. We may even see a cut before year end. This is not really what the market is expecting. So that could potentially be a major driver for gold prices to the upside. But for now, it's a patience game. Quite often with gold price, a gold investment, you have to fall out of love with it before you can fall in love with it again. And sometimes feel that, and we've seen quite a few of those developments. So for now, it's underowned by ETF investors, it's underowned by the futures market, by leverage funds, and we're waiting for a spark, and we may have to be a bit patient before we see that eventual spark. So 1,900, 2,000 for now.
Okay, interesting. So let's move on to silver. So, it definitely has this dual role as both the precious and an industrial metal. And so the influences on this can, I suppose, come from a variety of different factors. So what are some of the key points of interest that you see for silver moving forward?
Well, silver is really depends on three different markets. It depends on gold, probably most importantly. It depends on the dollar, but it also depends on what happens in the industrial metal space. And early this year, where we were looking for stimulus to support the Chinese economy, which is still not really forthcoming, we did see quite a bit of a jump in the industrial metals before they trade lower again. And during we had a period time just recently where both the industrial metals, the dollar was moving higher, gold was moving up, and the dollar was moving down, and that's really the foundation for a strong move higher in silver. Right now, some of these are not really playing their parts. We're seeing industrial metals still trading sideways, looking for the green technology development or the green transition to have an underlying support for key industrial metals. But at the same time, we also have the weakness in China, where we now see the latest data pointing towards deflation. Both PPI and CPI was negative in the recent update, and so we're waiting for some kind of a stimulus bazooka from China, which I think we will see later this year. When and if that occurs, then again we'll add some fresh support to industrial metals, and that will also play through to silver. So for now, it's once again just mostly stock watching gold prices, but as we can see from the recent developments and development and price actions in general, silver always tends to be will be a high beta. Gold basically moving higher, rallying faster and dumping faster, and that's just the nature of the beast. But generally, supply seems to be tightening in the silver market, and with that in mind, and based on our beliefs that we will see higher gold prices and industrial metals, especially something like copper, will eventually find fresh support. We see silver potentially outperforming once again, thereby driving the gold-silver ratio back down below 80 once again, and perhaps even lower than that.
Okay, interesting. And finally, for the precious metals, looking at kind of the PGMs. So platinum, palladium, they have a strong tie-in with the EV economy. What's your outlook here?
I'm not a strong watcher of palladium. It's simply too smaller metal, but platinum has my interest simply also because it's very, to a certain point, linked to gold and investment in general. Platinum has been, I would say, a bit of a disappointment this year. We are seeing the market starting to tighten up, but for now we're missing the ETF demand really to tighten the market further, to drive it higher. So at this point in time, it's still trading at a discount of around $1,000 to gold. I see that discount narrow over time. The demand for better emission engines in diesel cars is still growing, and while we can move away from gasoline-driven cars, move towards EV, the diesel, the heavy trucks, and so on, that's still an area where we will continue to see growth, and that will continue to require strong demand for something like platinum towards the converters. So I think with that in mind, and the tightness that we are seeing have started to emerge, I maintain a positive outlook for platinum as well. And then if we do get some investment demand into the market as well, and that tighten it up further, I see this discount to gold from $1,000 easily back into less than $800, so maybe even $700.
Okay, great. And, aside from the precious metals, can you maybe talk a little bit about, which commodities are you most positive on at the moment? And, is this related to kind of the energy transition or EV thematic that's, quite strong in the industry right now? Yeah, go ahead.
Well, I think once again we have to just to observe the fact that the commodity prices are not only driven by demand, and because obviously demand right now is there's a lot of questions being raised about demand. We got the slowdown in China, we got economic weakness seeing here in Europe as well. We have potential for U.S. growth also slowing in the coming months. So demand obviously outlook is clearly not as strong as we would have seen previously. But adding to that, we need to be very careful about the supply side as well. And supply has been tightening up. We're seeing that in the oil market right now. Yes, some of that is politically and financially motivated by Saudi Arabia's 1 million barrel cut. That will not last forever. But it just highlights the importance of supply into a market, and that prices can rise even though we have an economic slowdown. And I think that's what the supply side will probably be the main focus, and the reason why we still see upside potentials for commodities in general in the coming quarters. We have had quite a significant correction since the panic peaks last year when Russia invaded Ukraine. We corrected around half of the rally we saw during that time, and now we've seen a bounce here in June and July. Into August, it's become a little bit more one cylinder engine, because right now the strength is primarily coming from the energy sector, but and that is likely to continue. I don't see oil prices return to 100 plus, but I see it at least stay in this kind of area. And if we have tightness in the market, we have to remember from an investment perspective, you have what we call backwardation in the market. It basically means if you are investing into commodities, if you have backwardation, you are getting basically free money on a monthly basis because of the positive roll that occurs when you rolling positions in a backwardated market. And that's backwardation we're seeing not only in energy, but we're also seeing it across some of the agricultural commodities. Weather-wise, obviously, it looks like we are facing a challenging period on the agricultural front. We already seen that there worries about both sugar prices and rice prices. Orange juices hit a record high. We got production in Florida falling off a cliff. These obviously smaller isolated markets, but generally we have to be somewhat worried about the outlook for food commodities. But looking at the where I find where I'm mostly interested, I think is still in the green transformation metals, and the lack of additional supply that's coming in over the coming years. Just think about the one thing is that we roll out EVs, electric vehicles, we build batteries, but eventually the whole grid system needs to be upgraded as well, and that is a copper intensive project that will unfold over the coming years. And with supply being tight, then we still have an upside potential for copper. And I think just the price action the last 6 months speaks volumes. We've been trading sideways, even though Chinese economy has been disappointing, and that's accounts for, up until now, has been accounting for around 50% of global copper demand. So that just highlights the market that is reasonably well supported. So I like the metals. I like, as you probably from the beginning of our talk, I like the precious metals simply from the fact that we are seeing inflation starting to becoming more sticky. We are seeing the risk of stagflation, which will underpin investment metals in general. So I think that's really where my focus lies. And then still wondering why a very, very key source of energy, natural gas, especially US natural gas, has continued to be remain so cheap at a time of scarcity of energy. But yeah, that's another story.
Absolutely. And I suppose to close things off, this has been kind of a frequent topic in some of the panels that we've done at the one-to-one events. But what sort of theme would you use to define what's going to be happening in the commodities and investment market in the coming years? So, since I've at least been working in this industry, there's been kind of very distinct focuses on ESG, the energy transition, market volatility, such as like what happened during COVID. What do you think is going to be kind of that main theme to define next year?
I think it is still the energy transition, because what it means is that investment into to traditional energy sources is struggling, because if you're an energy company and a big oil major and you're worried about peak oil within the next 5 to 10 years, are you then really willing to put billions of dollars into new investments where you're going to make your money back in 5 to 10 years time? That's really a big question that's being raised there. And also right now, once we all talk about energy transformation, but or the energy transition, but so far it's really only been an energy addition, because global energy demand has not come down, is still rising, and that basically means so far the only thing we achieved with renewables is that it has managed to cope or cover the increase that we're seeing in energy global energy demand. So as long as energy demand remains as robust as it is, then obviously we need continued investment coming into this space, and that is really the big question, whether that's going to be enough, and that means the energy transition is one where we in the interim could see higher prices for traditional fuels, but it's also one where we will obviously continue to see rising demand for key industrial metals. So I think that theme will continue to play out. And then, but then, if I may add, I think as we talked about next year, I think it is the realization that inflation is we're not going to return to the Goldilocks scenario we had for the past couple of decades, where inflation was nowhere to be seen. We have to get used to a higher level of inflation. That is raising some challenges, but it's also raising the awareness about investment where you perhaps can shield yourself against these higher than expected inflation, and that's obviously where commodities come in.
Okay, interesting. Well, that's such a great kind of in-depth overview of both the precious metals markets and other commodities. So, Ole, I really want to thank you for joining us here at 1 to 1 today.
Thank you, Amy. Thank you.